This is your credit score. And believe it or not, that score has the power to make your life awesome or not so awesome, which is kind of a big deal, right? So the question is, how can a simple number like this be so important? Well, it's all about credit. See, credit allows people to buy things they need now and pay for them later. So unless you have enough cash on hand to buy all the important stuff you need in life, like a car, house, college education, oh, and yeah, stuff like that too, then you're probably gonna need credit. But there's a lot of people in the world, and banks can't give loans to everyone. So they use this big fancy formula to figure out who's more likely to pay them back. They take all your bills, paid, unpaid, paid late, then multiply and divide, equaling your credit score. If you have a high score, great. Banks will gladly lend you the money for the things you need. Bad score? Well, one of two things will happen. They won't give you loans or credit, or they will, but they'll charge you crazy fees and interest. And that's when things get messy. Over their lifetime, people with bad credit can pay up to $250,000 in extra fees. That's a $250,000 nest egg gone. Of course, banks don't go out of their way to clarify this because they're the ones getting the $250,000. The less you know, the easier it is to slip the fees past you. Fine, you say, I'll just live without credit. Well, think again. Landlords can check credit scores, so can employers, insurance companies, even cell phone providers. But hey, don't be too intimidated. There are actually many things you can do to start building a great credit score. First and foremost, pay your bills on time. Every time. In full. Second, expand your credit. The more lines of credit you have that are well managed and paid on time, the higher your score will be. Just don't take on too much and keep your balances low. Third, keep your credit cards. The longer you have a particular card, the better it is for your credit. Canceling a card is worse for your credit than not using it. Finally, check your credit report. If there's incorrect information on there, you can dispute it and potentially improve your score. Bottom line is, with a little discipline, it's possible to build a score that will make borrowing money easier and cheaper, opening doors to a life full of possibilities. So take control of your financial life today and make tomorrow brighter than you ever imagined. Applying for a loan online can be a safe and convenient experience if you know how to avoid identity theft and fraud traps. So here's a few tips on how to protect yourself when borrowing money online. To begin, start at the top of the lender's website and look for the green padlock in the address bar, along with HTTPS. This means the information you type in will be encrypted, which helps prevent eavesdroppers and hackers from stealing your personal info. If you don't see the lock, then any info you share on the site is not protected and can be accessible by anyone with a little bit of internet hacking skills. Also good to know, emails are not encrypted, so never send confidential information via email. Next, make sure you are borrowing from a licensed lender. The license should be displayed in plain view directly on their site. This means that you are dealing with a company legally licensed to operate, lending their own money, which can be the safer and cheaper alternative for getting a loan. Can't see any license? Then you might be dealing with a middleman trying to sell your information. Making sure your lender is licensed to operate in the U.S. and in your state also means that you are protected under federal and state laws, which is not the case for non-licensed lenders. Last, consider the fees. Are they straightforward and easily visible? Many times, the advertised price only applies to certain applicants, so even if it looks like a great deal at first, you could end up paying more than expected in the end. So be sure to read the fine print. Some examples of unexpected fees might be the annual fees, prepayment penalties, overdraft fees, and late fees. Good to know. Some websites won't tell you the price until after you input all of your information. That's a bad sign. If the fees are calculated up front, you know exactly how much you will end up paying, and it means the lender is being open about their prices, which is a good sign. So to recap, here's what you should remember. Protect your information. Work with trusted, licensed lenders. Pay attention to price. And remember, the secret to staying safe is staying informed. So follow these steps, and you'll turn your credit into a powerful financial tool. We all know that having good credit is important, but what can you do right now to build a better credit score? If you don't have a credit score, it's important to establish one. You can do this by taking out a credit card, like a secured credit card or a gas card. Just make sure all your credit relationships report to the major credit bureaus. Then, demonstrate you can manage credit responsibly. A good rule is to keep your balance below 30% of your credit limit. If you go above that limit, make sure to pay it down. And try not to max out your card. It can make you look high risk because it shows lenders that you've exhausted all your credit lines. One way you can start, using your card to buy things you used to buy in cash. That way you know you can afford to pay it back. Try not to cancel a credit card either, even if you haven't used it for a while. Because when you cancel a card, it removes available credit you have access to. Next, build your savings. Consistently adding to your savings may not build your credit, but it can keep you from missing a payment even if something goes wrong. When you're ready for new lines of credit, try not to send out multiple applications in the same short period of time. Each request shows up on your credit report, and too many might make you look credit desperate. Instead, wait for a response from the first before applying for another, even if you're in a rush. And check your credit report at least once a year and dispute any inaccurate information. Of course, mistakes happen, and you might fall behind on payments, but it's what you do about it that affects your credit score. Therefore, it's usually best to talk to your lender directly. First, work out a payment plan right away. It can be cheaper than going to a collection agency, and it's better for your credit because any account in collection will hurt your score and remain on your report for up to 7 years, even if it's paid. And remember, no matter how bad it seems, lenders have probably seen worse. And they want to solve the problem as much as you do. Building good credit takes time, but ruining it can happen quickly. So keep balances low. Don't cancel your cards. And pay on time. As long as you stick with it, your score will improve and you'll be on your way to a brighter future.
Credit cards come with many great benefits and potential risk. But if you know what to look out for, you can use your card to your advantage. Before signing up for a card, it's important to do your research and compare terms. Check the annual fees, interest rates, and what rewards or benefits they offer. In general, the lower the interest rate, the better. But in some cases, the annual fees are so high that they offset the benefit of a lower interest rate. So make sure you consider the fees plus interest when you're making your decision. But keep in mind, if you pay your credit card in full each month, you'll avoid interest entirely. That's money you can apply to your savings, use for an emergency, or that can be applied to your annual fee, allowing you to save money. So be sure to consider all the information and choose the card that fits your needs. And think honestly about how many times you've missed a payment in the past year. If you think you might be late sometimes, factor those fees into your decision. Once you have a card, make sure you know what day your payment is due each month. If your credit card allows you to set up reminders by email or text, do that so you'll never forget. This is important because if you miss a payment, you may be charged a late fee. And that late payment may stay on your credit history for up to 7 years, which could hurt your score and lead to higher interest rates. Next, start a habit of setting aside money from each paycheck. Then, when your bill is ready, plan to pay off the balance in full each month. That allows you to avoid interest. And over time, paying in full and on time should improve your credit, which can even lead to lower interest rates. Another thing to remember is to spend within your means. Just because you've been approved for a credit limit of $300 doesn't mean you should borrow that at once. For instance, Let's say you've been eyeing a new gadget. You could put the whole thing on your card and pay it back over the next year. But then, two things will happen. One, you'll end up paying interest, which means that $300 gadget will actually cost much more. And two, you may not have your card available in case of an emergency, like if your tire blows out. That's why you should keep your balance low, save money, and only charge what you'll realistically be able to pay back in full at the end of the month. Finally, keep your eyes open for hidden fees. Some lenders charge fees for late payments. Others charge if you request a cash advance, increase your credit line, make a payment by phone, or even if you talk to a customer service representative. The good news is, all lenders are required by law to disclose all their fees, so do your research. The contracts may be long, but the summary of fees is pretty simple, and reading it could help you save money. Those are some of the biggest risks. Stay tuned for more tips on how to get the most out of your credit card.
Did you know that 58% of Americans haven't even tried to figure out how much they need to save for retirement? Whether you're older than 65 or just planning ahead, managing your finances can be really important. Meet Mary. Mary receives monthly benefits from the government, along with a small pension from her former employer. She takes prescription pills for her blood pressure, which she factors into her budget, along with food and housing expenses. She also prioritizes savings. She sells antiques on the side to earn a little extra cash and contribute to her future goals. For Mary and millions of other Americans, the great thing about government benefits and employee pensions is that they're reliable. She knows when and how much she'll get paid every month, so she can budget her money accordingly. However, if an unexpected medical expense were to pop up, or if she'd like to go out to a fancy dinner or take a vacation, she'd like to make sure she'll have the funds available. That's why it's important for Mary and you to save. Every month, after taking care of food, housing, and your health, put aside whatever's left in your savings account, even if it's a small amount. Just remember to set goals and keep track of them each month. Another valuable tool is credit. A good credit score could help you access credit, such as a small loan or credit card, and could really help if you're in a bind. You could buy that medicine this month and pay it off the next, or treat your visiting grandchild to dinner before next month. And with a better score, you could access better financial products. 90% of top lenders use your FICO score when making a decision, which means your score may carry more weight than how well you know your local banker. One financial tool that you may not have considered, technology. It could really help you budget your money and save for the future. For instance, if you have a smartphone, you could set up savings reminders on the day you receive your check or direct deposit. Or if you have a computer, smartphone, ebook reader, or tablet, you could go to your bank's website and manage your finances from there. Just make sure you're visiting internet websites you can trust. Before entering any personal information, look for the security button at the top search bar, usually a green lock. This tells you the website is secure. If you're not sure where to begin with technology, many libraries and community centers offer free or low-cost computer classes. You could also ask a family member or trusted friend for help. But remember, your finances are still yours. If you have someone help you, make sure you feel comfortable about the information you share. Finally, be very cautious. From time to time, you might receive a phone call from someone offering a loan or an email requesting a donation for a charity. These could be scams. Just because they contact you and say they're from a certain company doesn't mean they actually are. That's why, if you're ever unsure about the person or company you're dealing with, end the call or close the email without giving them any personal information. Then do your research. If they're reputable, call them back yourself from a number on their website, not necessarily the number they give you, because when it comes down to it, your finances are yours. So think about how your credit and savings could help you manage your finances and meet your life goals. You should not only see the rewards, but you may inspire the rest of your family too.
You know your credit score is important. But what about your credit report? There's a difference between the two. And understanding your credit report can save you serious money. See, your credit report is a detailed record of your entire credit history. So your credit cards, financial reports, and loan inquiries, they're all on your credit report. And all that information is used to calculate your credit score. Now, there are 3 major credit bureaus that collect data and compile credit reports, which are then used to create credit scores. And while their scores may be slightly different, they are typically based on the same 5 things. Most important, your payment history. Whether you've paid on time, late, or not at all. Next is your debt-to-credit ratio. Then, the length of your credit history, how often you request new credit, and what types of credit you use. Be aware that some of these are more important than others. Another good thing to know, annualcreditreport.com is the only official site authorized by federal law where you can obtain a copy of your credit report for free once every 12 months. And you should definitely check that report. Why? Because your report is what banks and lenders use to make decisions. And it's up to you to make sure what's in there is accurate. You won't be able to eliminate mistakes you've made, like late payments or unpaid loans. But if there are other errors, like incorrect personal information or fraudulent activity, then contact the credit bureau and let them know. By law, they have 45 days to issue a ruling and fix mistakes, so stay on them because fixing those errors can help improve your credit score. And, as you know, a good score can lead to a future full of opportunity. So always check your credit report and make sure it's up to date.
A credit card is a powerful thing. If used properly, it could help you increase your spending power, avoid interest, and improve your credit. So how does a credit card work exactly? A credit card is a revolving line of credit. In other words, it's a loan with an open-ended lending period and a limited amount that you can borrow, otherwise known as your credit limit. So let's say your credit card has a $300 credit limit. Suddenly, you have an unexpected medical expense, $100 for prescription pills. You won't have the money until your next paycheck, but your health can't wait. With your credit card, you can buy the medicine now and pay for it later. It's like being able to get an instant limited loan. This increases your spending power, one of the key benefits of using a credit card. However, you don't want to use it too much. In fact, experts suggest keeping your balance below 30% of your credit limit. A higher balance makes you look riskier to lenders because you have less available credit. Another reason to keep your balance low, interest. Your interest rate is applied to your balance. If your balance is higher, your interest charges will be higher too. Let's say your interest rate is 20%. The moment you spend $100 on medicine, that interest rate starts calculating. But here's a little secret. If you pay your balance in full each month, you don't have to pay the interest, making your credit card like an interest-free loan. However, if you only make the minimum payment, let's say $25, you get charged 20% interest on the remaining $75. And if you pay late, you may even be charged late fees or face an interest rate increase. That's why it's so important to keep your balance low. And if possible, pay in full at the end of each month. That brings us to another benefit of a credit card. Paying on time and in full each month looks really good on your credit report and helps increase your credit score, which really comes in handy when shopping for a house, car, or even an apartment. How does this work? On your credit report, there is a tracker of how many times you pay on time. Every time you pay on time helps your credit. Using a credit card can also help you better track your purchases. Unlike with cash, you'll have a record of what you charge, which can help you better budget your money. Finally, your credit card helps protect you from theft and fraudulent activity. That's because you won't have to carry as much cash around. And plus, if you notice a fraudulent charge on your card, you can dispute it. Those are just some of the benefits. Stay tuned for more tips on how to get the most out of your credit.
When you apply for a loan or credit card, you need to pay attention to your interest rate. It can seriously affect how much you end up paying. For example, take these two. They both want to finance the same $1,000 oven. This gal has good credit, so the store gives her a 10% APR or annual percentage rate, which means she'll pay 10% interest on the oven per year until it's paid off. 10% on $1,000 is $100, bringing her total to $1,100 for the year. She sets up a one-year plan, pays $91.67 a month, and she's done. This guy, on the other hand, doesn't have good credit, so the store gives him a 25% APR. That's an extra $250 per year added to the oven. He can pay it off in 1 year with a monthly payment of $104.17 or 2 years with a monthly payment of $62.50. He goes with the lower payment because he thinks he's saving money, but in the end, he actually pays more. Why? Because it's a 25% interest rate per year, so he ends up paying an extra $250 on the oven the first year and an extra $250 the second year, bringing his grand total to $1,500. $1,500. That's $400 more than she paid for the same oven, and $250 more than he would have paid if he went for the one-year plan. So, what's the lesson? 1. Credit affects your interest rate, and your interest rates can seriously impact your total cost. The good news is, all lenders are required to show you the interest rate and even the total amount to repay in some cases before you're approved. So do your research first and find the best one. And 2, don't be tempted by low monthly payments. Instead, look at the interest rate, the amount you're borrowing, and how long it will take you to pay it off, because that's where you'll find the true cost of credit.
You've heard about the benefits and risk of using a credit card, and you're feeling pretty confident, right? Well, if you want to get the most out of your credit card, there's another thing you need to know about: finance charges. These are the fees that a lender charges you in exchange for the ability to make purchases with your card. There are several kinds of finance charges, but the most important is your interest rate, which for credit cards is commonly known as your annual percentage rate, or APR. This is the yearly interest that's applied to your balance. Your APR is a set rate that doesn't normally change. If it does, your provider is required to notify you. What can vary is the method by which your interest rate is applied, but the critical part is your balance calculation. Your provider uses a balance calculation to determine the dollar amount your APR will be applied to and how. There are 3 common ways that lenders calculate your balance. Many use an average daily balance. Others use your previous month's balance, while some use your average daily balance over 2 months. Make sure that you read your terms and monthly statement to understand what you're being charged. Now, aside from your APR and balance calculation, there's another thing that can really affect your finance charges: compound interest. Some lenders charge you compound interest if you pay late, or if you only make the minimum payment each month. To understand compound interest, let's say you spend $100 to replace a flat tire, and you only pay a minimum of $25, leaving you with a balance of $75. At the end of the month, your interest charge would be applied to the remaining $75. Depending on your interest rate, it may not seem like much, but let's just say you're charged $3 of interest, bringing your amount due to $78. The next month, because of compound interest, your interest isn't calculated based on a $75 balance, but your new balance, $78, plus any additional purchases you may have made. This is what we mean by compound interest, or interest on top of interest. And it keeps calculating whether you make a new purchase or not. So even if you didn't buy anything new, you'll still see the interest adding up on your carried balance each month until you pay it off entirely. This is how banks and financial service providers can make a lot of their money. And for you, the consumer, that tire can get expensive very quickly, which is why it's so important to pay in full each month within your grace period, which is the time between the end of your billing cycle and your due date. The differences in terms from one credit card to another might seem subtle on paper, but they can have a big impact in real life, which may lead to higher interest charges, higher bills, and less available credit. If you master those details, you can not only save money on interest and fees, you can also have more available credit to pay for unexpected life events, like medical emergencies, and more money for long-term goals, like a nicer apartment or car. So do your research and understand your terms. It'll help you become a true master of your financial health.
Sometimes it seems like lenders can have all the power. But when you work with a state-licensed lender, you have rights and power too. And if you know what they are, you can deal with lenders confidently and get access to the safest financial products. There are lots of laws protecting borrowers like you, but one of the most important is the Equal Credit Opportunities Act. This states that lenders can't deny you based on certain things, such as your age, sex, race, religion, nationality, marital status, or because you receive public assistance. They can only base their decision on whether you meet their credit or financial requirements. And if they do deny you, they're required to tell you why and what information they use to make their decision so you can gain access to the products that you want. The second law is the Fair Credit Reporting Act. Many companies, like banks and lenders, make big decisions based on your credit report. That's why it's important to make sure the information is accurate. The Fair Credit Reporting Act gives you the right to review, dispute, and correct any inaccurate information on that report. To obtain a free copy of your report, go to the federally approved website, annualcreditreport.com. If you find any errors, contact the Bureau so you can fix mistakes. The bureaus are required to fix any mistake in 45 days, but it's up to you to report those mistakes and reclaim your right to better financial services. Finally, there's the Fair Debt Collection Practices Act, which protects you from abusive debt collectors. For example, debt collectors can't contact you after 9 p.m. or before 8 a.m. in your time zone on any day. They're allowed to contact your family or employer to locate you, but they can't threaten them with responsibility for your debt. In addition, they cannot harass, intimidate, humiliate, or threaten you in the process. Together, these laws are designed to ensure you get a fair shot. But remember, these laws can only protect you if you work with a licensed lender, so make sure they're licensed and know your rights, because when you're better informed, you can start making credit work for you. Let's say you're here, and you want to get there, where the life you want awaits. A budget will help guide you all the way to your destination. It's like a roadmap to the life you want. So how do you create a budget anyway? It's not as hard as you think. First, write down your income per week, month, and year. And be realistic. Only include money you know you will have, and leave out possible future pay increases. Next, write down all your monthly expenses. Start with your regular bills like rent, phone, electricity, car payment, etc., and then add an estimate of your everyday expenses like food, transportation costs, and so on. Add those together and compare it to your monthly income. If your expenses are lower than your monthly income, the difference is added to your savings so you can save up for your goals. If your expenses are higher than your income, go back, review your budget, and see what you can do without. Now, here are some tips to staying disciplined. For instance, use cash instead of credit cards to make sure you have money to pay for all your expenses. And don't be impulsive and spend without first considering your budget. Also, review your bank statement and spending every month and identify areas where you can cut back. And remember to budget for future spending. Write down what you'll want in the next few months and figure out how much you'll need to set aside each week to make it happen. But above all, stay committed. Achieving your life goals may take time, but a good budget will help you stay on track until you reach your destination.
Between school, work, and friends, you've got a lot of things going on in your life. And compared to those, financial issues like savings and credit scores may not seem all that interesting or important. But here's the thing. By developing just a few good financial habits today, you could dramatically improve your life down the road. Seriously. So what are these few simple habits? First, give money to your goals through savings. There are 2 big buckets where you can put your savings. One for short-term goals, another for long-term stuff. A savings account is great for short to medium-term goals. The challenge? Make it a habit, just like looking both ways before crossing the street. Remember your goals before making impulse purchases. Like instead of going out so many times to bars and restaurants, stay in a few more nights a month and put that extra money in your savings. Challenge accepted? Over time, these small choices could really add up until eventually you could save so much that you can afford big things like a car or a better apartment and pay for unexpected things like if you get sick or lose your job. Those are pretty big, but what about the long-term life goals like buying a house or retirement? You can't just get a house because you want one, right? Don't panic. No one expects you to do that stuff soon. But the good news is, if you start investing in things like an individual retirement account or an employer-sponsored 401k plan now, the easier it should be to do all those amazing things later. The reason is compound interest. The sooner you start, the more years that interest has to compound in your favor, allowing your small sum to snowball into something much, much bigger. So, while your friends who didn't save may still be working, you could be traveling the world with your retirement savings. Another great thing to start early, building your credit. Building your credit is kind of like building your career. Before you can reach the top, first you gotta get in the door. The thing is, though, if you're just starting out and only have a short credit history, creditors may not have enough information on file to know what kind of customer you are. And if you made a few mistakes when you were younger, the information they do have may not be very helpful. But that's okay. You can turn it around by slowly proving your credit worthiness. A few good places to start? Open a credit card. Get a store card or a secured credit card, or finance a purchase. Then show you're trustworthy by paying it on time, every time. Remember, good credit scores aren't given out. They're earned. The longer you pay on time, the more you can improve your score, until eventually your financial resume should be strong enough that you can do incredible things with your life, like buy a house, or maybe even start your own business. It might seem like a long way off, but the decision to achieve your lifelong goals is made every single day in the small financial decisions most people overlook. And with so many great online tools today, like payment reminders and online budget calculators, it's never been easier to make good choices. So remember, give money to your goals, build your credit wisely, and take advantage of technology. And of course, start early. If you do, the sooner you might turn those big dreams into reality. So why not start today?